We're going to go through some detailed explanations as to how I calculate whether a property is good for me. Again, please note we are talking about some things related to tax. I am not a tax professional. I am no longer qualified, even though I was as a financial planner. I am talking about my situation, how I do my calculations, and I'm very sure some of them may apply to you. If in doubt, speak to a professional, come to our guys, we can also help as well. The long form of this video will be found on our YouTube channel Empowered by Legacy. I want to buy a property. I want to look at the basic details as to whether I make money. Now, most of you guys at home are looking at rental yield. That means how much rent am I going to get and how much mortgage am I going to have to pay. You guys are looking at this situation going, okay, if I am paying $1,000 in mortgage a week and my rent is $900 a week, then technically I'm losing $100 every single week. And you guys are assessing whether you can manage that. But that is not the case. That is not how negative gearing is calculated. That is not how you win in property. And I'm going to show you how I do it for me. Again, not necessary for you. Don't take me to court. But you may get some tips and tricks. First and foremost, I'm going to look at the property in its entirety. The first thing I look at is I even find on realestate.com, what is the area do? I type in market research on this particular area. ChatGPT is your friend. Realestate.com is your friend. Information is readily available. I'm looking for the 5-year projection and the 5-year forecast on what's happened in the last 5 years. Past indication is not an indication of future performance, but it's fair to say in most of Australia's housing market right now, you're doing okay, right? Things are moving forward because there is a housing crisis. But first and foremost, I have to be relatively bullish that the market is going to go forward and I'm not going to lose money on capital value. Now, the first rule of buying a property is if it all goes to shit, you just hold on to it and eventually go back up again. Right? So never invest more than you can afford. You never want to desperately have to sell a property. Because the example is here, you got $1 million house, you're sitting in it, everything's well, you go to sleep, it's worth $1 million, you wake up, it's worth $800,000. Can you still buy your groceries? Answer is yes. Technically on paper, you've lost $200,000, but in reality, you haven't actually realized the loss. You're just worth $200,000 less. Your bank balance isn't any less. Nothing else has changed. Just your net worth, your value. The only time you actually lose that money is if you sell the asset. And that's when it's a problem. So, first and foremost, A, can I afford to buy the house? B, based on this, if the market goes to caca, can I hold on to it? And C, do I have a relatively positive outlook for this property? Now I get to the metrics. How can I keep affording this? Am I losing each month? But let's say, for example, the mortgage is $1,000 a week. I'm going to base this on interest only for ease of use. So let's just say $1,000 in interest every single week. Now I'm going to say, I'm going to throw a ridiculous number out there. I'm only getting $600 a week in rent. So I'm losing $400 every single week. Now you don't have $400 times by 52. Let's just use these numbers. 4 times 4. $1,600 every single month, times up by 12. You're looking at close to $20,000 essentially that you are short every single year. Now that's a lot of money. Most people go, $20,000. I can't deal with that, and that is absolutely fair, nor should you have to. Because the next calculation I'm going to make is depreciation. I'm going to ask for a depreciation report from my agent, from the client, or even from a third party to give me an estimate on this. Depreciation only works on new dwellings, not on very old dwellings. That is why in my space I'm only dealing with new stock, new development stock, new house and land packages, apartments. That's what's good for me. Assume now the new build, the depreciation that is $20,000. Assume my tax rate is 45%. Thank God. So on that depreciation of $20,000, 45% is what I'm getting on my tax rate back. So on that $20,000, let's say I get $9,500 back. That's money I get back from the ATO. I don't have to wait to the end of the year. I can do a tax adjustment form through the ATO with my accountant to make sure I get that money back net. Now, if you're not on the 45% tax bracket, you could be on the 37 or 32 or whatever it is. Just look at your tax bracket, see how much your wage is gross, and then you can find out what tax bracket you are. But you basically times that money, and then you times it by your tax rate. That gave me my depreciation amount. Then I'm going to go through and look at my negative gearing. Only on interest, nothing on the principal. So if you're paying principal and interest, disregard the principal number. That's value to me. So if you're paying 20K extra interest each year compared to what you're receiving in rent, you do the same number. Do that $20,000 times your marginal tax rate of 45%, 32%. So 20,000 times 45% gives you $9,000. Lo and behold, $9,000 I'm getting back in depreciation, $9,000 I'm getting back on negative gearing. That's $18,000 that I'm getting back on my tax component. Now that cash flow from the ATO, you do a variation with your employer, with the ATO, you get that money back every single month net, so you're not cash flow short. Now, where are we at the end of the year? Congratulations, ladies and gentlemen. It's $2,000 cash flow each year to buy this place. Essentially equivalent of what you probably spend on coffee every single day, right? $2,000 every single year, $200 a month, right? Thereabouts. I know those numbers are rough, guys. It's Wednesday over here. It's hump day. It's late in the afternoon. My numbers are way gone. But anyway, $2,000 a year is what I'm into it for. Now, all I have to do, I go back to point one. Do I believe the market is going to go up more than $2,000 a day? Simple. Simple as that. Now, I'm going to give you an example of an asset that I've recently purchased in Thornhill Park. I bought it not because it has the most stellar returns. I've got a bullish view of Melbourne over the next 10 years. My personal view doesn't have to be yours. I just believe with the new taxes being introduced to developers in Melbourne, the supply is going to dry up, and therefore it's going to be harder and harder to find land. It's still a big CBD. Queensland's expensive, Sydney's expensive, Melbourne is still dirt cheap. I bought a house there for $695. I think out the calculation, I'm going to be negative cash flow $200 every month for a $695,000 place. Cheapest chips in the context of where I live in Sydney, right? Off the essence of that, I've chosen its worst calculation of capital growth. It did 1.95% last quarter. So that's a very bad return. In Queensland, it's doing 12 to 13% a year, but you're buying it more expensive. In Sydney, it's doing close to 7-8% in certain places. But, this place is only doing 1.95%. Now, hoping in the long term, it's going to be higher. But on this bed, which is costing me $200 a month, less than a coffee bill, $200 a month, just based on 1.95 compound interest on this particular deal, I'm $308,000 better off on a very bad capital gains bill. Very bad capital gains run rate. $200 a month over 5 years gives me $308,000. $380,000 a year. So off that calculation, guys, it's very simple. If you put $200 a month aside right now, at the end of the year, you're going to have $2,400. At the end of 5 years, you're going to have $12,000. My $2,400 a year is getting me $300,000 plus dollars, close to $400K. So let's talk numbers here. Is there better returns than Thornhill Park in the world? Yes, but not for 620, not for 695, sorry. And why did I go for the 695? For me personally, my tax position, the land is less expensive, the building costs the same. So if the build is 400, the land is 300, you can only depreciate the build. You can't depreciate the land. So I'm getting better tax incentives off the back of that. And at the end of the day, $200 a month for $380,000 on a worst case projection. Do I believe it's going to go stronger than that? Absolutely. Otherwise, I wouldn't have bought it. But on just a very bad quarter, I'm $380K up with $200 a month. I can save my coffees. That's how I do my calculations. Again, come speak to us. Come speak to our specialists. There's guys here who can help you with all that sort of stuff. Give you some key components of it. I hope you're enjoying the long form, guys. This is how I do my personal investments. And I'm happy to share my personal portfolio with you. But my call is very simple. Despite the rental yield, step one, do I think it's going to win? Do I think it's going to grow and compound and there's a good upside to it? Check. 2, can I afford to buy it? is it going to drain my cash flow dramatically that I never have to sell it if I never need to? 3, what's the rental yield? And based on that rental yield, I add back all the money I get back from tax on depreciation, on as well as negative gearing. And then off the base of that, what's my worst case upside? And what's my, can I afford that? Now remember guys, the worst case upside is not $380,000. The worst case is you can lose $300,000. But if we go back to rule number 2, if I never have to sell it, will it recover? Yes. Right? And the likeliness of I'm losing 50% of the market in the housing crisis, I'm not going to say it's not going to happen, but it's probably not going to happen. Right? Simple point, guys. The numbers aren't always as they appear. Come back to them, do the figures as for yourself, and you can see how you can make it work. And by the way, the calculations are my fault in your park. Ladies and gentlemen, I deal with no deposit. The negative gear was that bad because I lent through my company's product to Power Money, which is 105% lent. 105% investment lend, no money down, cost me $200 a month in my scenario with my tax rate. You want to find out how to do it? Hit us up. Hope you enjoyed the video, guys. Take care. See you next time.